Hello guys, welcome back to another video. So this is part 2 of year-end adjustments for accounting from grade 10 to 12. In my previous um, year-end adjustment video, which was last week, I covered trading stock deficit and surplus consumable stores on hand, accrued income, accrued expense, prepaid expense, and income received in advance. So those are the topics that I tried to cover to help you guys how we deal with those transactions at the end of the financial year, how they are accounted for in the income statement and in the balance sheet of the business. I hope you are well, guys. I hope you are well rested and you're ready to take over this term. So if you like my videos, please don't forget to subscribe to the channel. Please like the videos. It helps the channel reach more people. So don't forget, guys, to like these videos. You find them informative, please like them. So without wasting any more of your time, let's get right into it. So we're now going to be talking about interest capitalized, right? Whenever you go to a bank or any financial institution to get a loan, there is going to be a certain amount that will be added to the original amount which you borrowed. So let's say you borrowed 12,000 rand from a bank. The bank will add a certain percentage as interest. It's like a borrowing cost. We're borrowing you this money, but instead of you bringing it back for 12,000 rand because I helped you in your time of need when you didn't have this money, I will add 3,500 rand on top of the 12,000 rand that you had borrowed for me, which the 12,000 rand was the initial amount. So I will add 3,500 rand to that, and 3,500 rand will be interest. So if you borrowed 12,000 rand plus the 3,000, we said 3,500 interest, we have 15,500 rand. So when the lender, which is the bank or any financial institutions that lends money, gives you the 12,000 rand, you owe them 15,500 rand. Now they say you will pay this 15,500 rand over a period of 12 months. Let's divide this by 12, and which means every month you'll pay 1,291 rand 67 cents. But if you only owed them, let's see how much was the answer, 1,291 rand 67 cents. But if you had taken 12,000 rand and you're paying it over 12 months, you would only be paying 1,000 rand. So the 291 rand 67 cents that you are paying on top of your 1,000 rand, it's the interest. So we have something called capitalized interest, which you will be dealing with. Interest capitalized in interest that is added to a loan balance, increasing both the balance and the eventual interest due. Interest capitalized can occur when the borrower is not making payment on the loan and interest continues to incur, or when the loan is used to finance the construction of a long-term asset. Let's say there is a particular construction company that is going to construct a road, a national road where there will be toll gates, right? So this company secures a loan from a bank to build this road. The government has given them permission. The government is like, we don't have money, but you can repay back yourselves by the toll gates. When you're driving from like the Free State Bloemfontein, let's say for instance, to Johannesburg, you are gonna find toll gates, right, to get to Johannesburg. So those roads are national roads, big roads, and there's a toll gate there. There are still big roads, national roads, which don't have a toll gate, like the N8. So what happens here is that the company gets money from a bank, they build that road, and the e-tolls, the toll gate starts to work, right? People are gonna be paying to pass that road. People who are driving will be paying, each car will be paying a certain fee for passing through that road, right? And the money that the construction company is getting from there, those toll gates will be the money that will be used to pay the bank, right? So the company is not paying the bank immediately after the loan. Okay, when you go to a bank and get a loan, you will pay next month. So I got the loan today, this month, on the 15th. I'll start paying interest next month on the 15th. But with this one, you might take 3 years to pay back that loan. You will only pay that loan, capitalized interest, when the business is making money from that long-term asset they have acquired funds to build, right? So there is also a difference between interest expense and capitalized interest. Interest expense is that one where you go to the bank as a business to just get a loan, maybe to do something small or to purchase maybe printing machines. You have problems with your printing machines and you just go to borrow and to the bank to borrow money for that, or you are trying to rent out a new space because you are trying to make use of the festive seasons. Everybody has money, so you're trying to monetize on that, and you want to open a store maybe in a certain area. Immediately you don't have cash flow, but you decide like, let me just get a loan and I will pay back the loan monthly, or with the monthly, because we're gonna get proceeds, which is we are going to earn an income from that store, and it will be able to pay back itself, right? So that is capital interest. It's expensed in the income statement, not capitalized, sorry. It's interest expense, which is written on your income statement as uh, interest expense, ne? Or expense on interest, or interest paid, right? So this capitalized interest one represent the cost of borrowing to acquire or construct a long-term asset, while interest expense is for short-term assets. Capitalized interest is loan acquired for long-term assets. So, unlike typical expense, capitalized interest is not expensed immediately on the income statement. Instead, it increases the cost basis of the related long-term asset on the balance sheet. By capitalizing interest, companies can generate revenue from the asset over time to pay it back gradually. That's what I said, constructing a road without money and using the bank for that. I hope you guys understand the difference between interest expense and capitalized interest, because you gonna have to be introduced to this in grade 10, 11, and 12, right? So it increases cost basis of the related long-term asset on the balance sheet. You're going to construct, it is going to be the cost of that land and buildings, right? You have acquired a land and you're going to build on it. So this loan that you have gotten will be the one that will be under land and buildings, because that's how much you had spent to acquire that long-term asset or roads. Now, let's talk about bad debts. Bad debts is any credit advanced by a lender to a debtor that shows no promise of ever being collected. So if you have been given an account by a clothing store and you are no longer available, they've sent you letters, they have called you, they have done all humanly possible to get you to pay them back, and you don't pay them, they have to write you as a bad debt. Now, the money you owe that store can be claimed back from SARS by the store. So the store, has to make provisions for that, that this debtor, whoever did not pay. So what normally happens when people are not able to pay back their debts is that the company extends too much credit to a customer and they are incapable of paying it back. In clothing stores, they will always be increasing your credit. We'll increase your credit, the money that is available in your account for you to buy for, without most times they don't even do affordability tests if you can really afford it. Just because they have given you 6,000 rand and you are able to pay it back, they just initially think that this person will be able to pay back 10,000 if we give them credit of 10,000 rand and they buy with it, they use it, they would actually be able to pay it back because they've paid 6,000 rand, which is a massive difference between 6,000 rand debt and a 10,000 rand one. So that's how they have bad debts, because they overextend credit facilities or access. And then when a bad debt, someone who had previously not been found to be able to pay back their debt, finally comes back to pay back a debt, it's called bad debts recovered. Now we have recovered that Ngobeni who have not paid us for the past 3 years, and after 3 years they come back, hey, I'm available, I now have a job, and I will be able to pay you back what I owe. It will be now a bad debt recovered. It's now under other income on the income statement. Yes, so and then it's under other income in the bank, not in the bank statement, sorry, other income in the income statement. That's where you write your bad debts recovered. So on the accounting equation, bad debts will increase your asset and they will also decrease your owner's equity. They don't affect your liabilities. That is how your bad debts will. And this is bad debts, right? This is your bad debts. Now, when the bad debts has been recovered, it increases your asset, it increases your owner's equity on the credit side because it is an income, and it increases your asset on the debit side, and your liabilities are still not affected by bad debts. All right, another subject when it comes to bad debts that we have to do before we close off this video is provision for bad debts, right? Bad debts are actually people that have ditched to pay their debts. Those are bad debts to the business. But another thing is provision for bad debts. It's a business saying, normally, on a yearly basis, we have observed a pattern that 5% of our debtors never pay back their debts. So every year, that business will do a provision for bad debts, right? So our total debtors, will look at the total of our debtors. We have 48,000 debtors on our trial balance, right? And we have to make provision for bad debts. So we'll say 48, and then provision for bad debts is 5%, right? So we'll take 48,000 times 5%. Times 5 divided by 100, and that will give us 2,400 rand. So the 2,400 rand is the provision for bad debts that as a business we have already anticipated that we are not going to get back this money. So that is the money the business says we are most likely to not receive it. So we might as well make contingency plans for it now, because that is a trend, it's a pattern. It might not be like this we may not collect more or we may not collect less than 2,400 rand. So this provision will be taken to the income statement as an expense. So that is provision. It be a provision adjustments. It will be a bad debt adjustment, right? Or provision for bad debts. You just write it like that on your profit and loss statement. So this amount will go as an expense. And then in the balance sheet, it is also transferred in the and provision for bad debt is subtracted from total debtors. So in your balance sheet, you have your amount of debtors is 48,000. Now we will minus this 2,400, and then the difference will be our debtors written on the balance sheet and will also expense in the income statement. Now let's look at the following example. The following balance appear in the pre-adjustment trial balance of San Bonani on 28 February 20.01, the end of the financial year, right? So the financial year ends on 28 February. Debtors control is 1,248, and then bad debts is 438 rand. And then the adjustment says write the debt of 48,000 of S Shilwani, a debtor of as irrecoverable, right? So we're writing that this bad debt would never have. Create a provision for bad debts at 5% of the debtors. So what happens here is that your debtors are standing here as the business, and your bad debts to date are 483, right? So this is your debtors to date. These are your bad debts that you have written off. People who are not paying you back amount to 483. Now what you do is that there's an adjustment that says write this year we are asked to write off the data of 48 rand of epsilon. That's irrecoverable. So what happens there is that you take 1,348 rand, you subtract this new bad debt, sorry. Bad debts decrease debtors control because those people will never pay us back. While debtors control are people who are still going to pay us back. So you take this amount minus this one, and your new balance of debtors control will be 1,300 rand, right? So now you take that 1,300 rand of your new debtors, you times it by 5%. This 5% provision we are asked to do. You times it by 5%, and then you will get 65 rand as provision for bad debts. All right, so this is how much we initially had as our debtors control, and now we minus the bad debt that we asked to write off this year, who will be irrecoverable. Shilwani, who will be irrecoverable, and then we are left with 1,300 rand. So that 1,300 rand is the amount in which the provision for bad debts will be made from. And now we will just say, so not 6, this will be 5/100, and then that will give us 65 rand. So provision, a provision for bad debts of 5% will give us 65 rand. So this will be the effect of the 65 rand on the balance sheet, on the accounting equation, and on the balance sheet. Thank you very much, guys, for watching. Until the next video.